You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
Our last and surely not least presenter of the day is NN Inc. and company CEO Harold Bevis. Based in Charlotte, North Carolina, it's a designer and manufacturer of high precision metal and plastic components for a variety of end markets, not the least of which is the auto industry. Real unique opportunity that Harold took on to transform this business, both from an operational perspective and also from a financial perspective. Cap, so a real small cap opportunity here, about a 300 million total enterprise value, and we'll get into some Q&A with Harold here.
Thank you, Brian. Okay, I realize I stand between you and a cocktail, so I got that. Following the Penske guy, I feel like the Monty Python saying of, and now for something completely different. We are a small cap turnaround, and Brian referred earlier in the day to financial engineering. We've had to do both operational engineering, and we have upcoming financial engineering. And last year I kind of talked through the turnaround. I'm a turnaround person, and I brought the turnaround team I've worked with for about 20 years to this company. It's very similar to what we've done in the past. And we're pretty much finished the first phase, which was really killing some bad volume that we had and becoming free cash flow positive. And really proud of it. I didn't really contemplate a really big downturn in the market for us. Our top customers, Cummins. Yep, we're connected to diesel fuel injection. And so they had a tough year. We supply them globally. And so we had a little bit of a top line pressure on us this year, but we kept doing what we said we were going to do last year. I'm going to give you a report card in a minute. And we were able to ramp up and gain some new business for us. These figures are a lot smaller than the last few presenters, but they're meaningful to us. And we're entering phase two, which is ramping up the business that we have won, as well as redoing our balance sheet. And we had our earnings last week, so I made a bunch of public comments about what we're up to with the financial refinancing as well as M&A. But our top line results are poised to pivot next year, in large part because of the new business that we won, but also recovery in some of our markets. I agree with some of the comments made about trucking, truck sales, car sales, and we're in other markets too. But I really do feel like we're at the bottom of the bathtub, and we can kind of see positive indicators for next year. So we're starting to feel good about 26, where this year was very uncertain and volatile. But we have been able to increase our EBITDA by 45% in 2 years. I've been here 8 quarters now. Last year when I came, I had been here about a year, and we were just getting organized. And we've been managing the company pretty well through the volatility. We had about $110 million of our sales lost money, and we had complete plants that lost money. So we had to kind of work that through, and that obviously takes, the revenue goes down, but your EBITDA goes up. And so that move is about over for us going into next year. We are in several markets. Auto's our biggest. 40% of what we do is making bespoke custom parts for automobiles, and the biggest being steering, braking, and fuel control. We're also in the electric grid. We're connected to data centers, Brian. So I can say data centers a couple times.
Say it as many times as you can.
Our second largest customer is a company called Itron, and they do grid management. And I don't know if you followed Itron at all. They had a really bad week last week. When they announced earnings, they went down 21%. They lost $1.5 billion of market cap that day, and it was because they reported down in revenue. And they said it, so I could finally say it. What's been happening with federal funds cuts has been cutting back on infrastructure investment in the grid. So while the demand keeps growing, the grid has had a problem, and now you see reporters calling it out, and Itron called it out last week and took a punishment for it. We're also in defense, and that's been growing for us. Lack of supply, and overall, we're having a slightly down year on a pro forma basis. We do have a global footprint. We have several thousand employees operating out of 24 plants. And I'm going to show you our China story. We have a big China story. And we have 2 wholly owned facilities there and a JV with a public Chinese company called Weifu. And the biggest customer is BYD. And we also directly serve Chery, Lee, Great Wall, and the BYD also. So we're really, really connected to the China automotive story. So against this transformation that we've done now for 8 quarters, we've had some light soft sales, which have held us back, but it's actually given us some breathing room to take out some of the underperforming capacity, and we've done it. Primary markets, we talked about automotive all day. So we're up to speed on that. We don't need any more of that probably at 4:30. But we are also on the grid. The grid's a big one for us. Siemens, Honeywell, Itron, that crowd. And they've had a tough year too, with the herky-jerkiness that has gone on with federal funding. But long-term good. It's all about timing, and very few things get canceled in that world, just pushed. And so there's been pushes this year. Defense has really taken off for us. We make parts for weapons, sighting systems, guidance, Patriot system, big end customers, Raytheon. And it's the same kind of thing. It's a small metal part that's bespoke. And commercial vehicles, we've heard a lot about that. It's going through a tough moment. We do have a long-term plan that's based on growing sales, but we had to really clean out some of the bad sales that we inherited here at this company. It's a 45-year-old company, but they really hit the skids if you look at the prior 5 years on performance, and there was some pent-up work to do, and we're through that. At this point in time, though, we're launching 150 programs with different customers. One of them was here today, and Finia tomorrow, and it's worth a lot of money to us. It's over $100 million of annualized sales. So, and they're very technical, and they go through a process that in steering and braking involves crash tests on completed vehicles. So it can't be shortcutted, and therefore they have a gestation period to come into the P&L, but we have a lot of them underway right now. So I want to report out a little bit. So last year, I was talking about getting our gross margins up over a 5-year period, getting our EBITDA up over a 5-year period, getting our headcount down and leaned out. And I want to report that we're on track with the plans that we articulated last year. Our adjusted EBITDA rates are now 11%, and our gross margins are 18.4% year to date. Year to date, we're up in adjusted EBITDA through 3 quarters. We're up in free cash flow versus prior year, down in sales in a couple areas. Talked last year about how we wanted to try to win $65 million in new business a year, and we were able to do that. And we're tracking this year also to do the same thing. So that will be about $200 million of business that we are now backfilling into our capacity that what I call price cleared. We had discussions with our customers like, our customers are like Bosch, ZF, Schaeffler, these type of people, and you have pricing discussions. And if you agree to get divorced, there's usually a notification period in the contract that's 18 months, unless they can get out of it earlier. So it takes a while to get out of that business. And then it takes same about a time about to ramp into the new business. And that's underway right now. From a start 8 quarters ago with no pipeline, we now have a quoted pipeline of $850 million, which is twice the size of our company. So, and we now have a 40-person engineering team working on all that type of development. So I really think that we're on the edge of becoming now a revenue story versus really a cost and fix it story. And next year, we're just like most companies going through our 26 business planning right now. And I can report out that we've added up our SOPs, our start of production on our programs, have an estimate of our end of production programs. And it's already going to add around 30 million, no matter what the base market does. And our steady state goal is 40. China, we've been in China for 20 years. We started the JV and our Woofy within 45 days of each other 20 years ago. And our goal is 1 billion RMB in the country. All of our sales are, we buy our metal in the country, we convert it in the country, we sell it in the country. The biggest end customer of both our JV and our Woofy, wholly owned foreign entity, is BYD. BYD is the big one. And we have long-term contracts. We already are close to being on track to the 1 billion with business that we've won in the country. So it's also our most profitable business. Our Wuxi plant in China is our most profitable business. So China Auto is a profitable part of our company. M&A is important for us also. We came here to kind of fix the core business, get it to be scalable, free cash flow generative, and then add to it. So we started looking at the beginning of this year, and we have a full business development pipeline, and we have a couple that are close. And we're right now trying to decide, do we couple it with our refinancing, or we're just refinancing to do it after? So we're getting advisors right now. And we're going to begin that next phase of the game plan. I went through the third quarter last week, but the basic game plan was that we'd made steady progress against the metrics that we've pointed out for ourselves. The only hurt that we've had really is in North American and European auto. So we've had less part production in our EDI portals than we had expected. And like was referred to earlier today, we had to variabilize a lot of our headcount. So I don't need to go through that at this time of the day, but we're tracking, and our investment thesis really, it's different than some of the other presentations of today. We're like a lot of steady state, everything's kicking ass story. You know, we're more of a turnaround special situation story for people that like that in your portfolio. So we're, as a company, we're towards the end of phase one here, and we're still improving our financials, even on down sales, and tracking into next year. And phase two, we're just getting ready to start. So we're looking for disruptive growth because of the M&A approach. And it's a target-rich environment. Although we're not that big, we're really big at what we do. So we get a lot of looks at global car production. Virtually all the OEMs, we're involved with them on the specific subsystems, steering, braking, fuel. We're kind of an expert at that. So that's who we are. And we think that we're in a good position right now and worth a look. We're seeing some cyclical recovery of our legacy markets. We're going through a steady ramp up of over 150 programs. If you do the math, there's no big ones in there. It's about $100 million. So they're a little less than $1 million per part. It's usually a part that we're making that's going into a system. And we really have a more streamlined footprint now. We've closed a couple of plants, and we've laid off a lot of people, and we've eliminated redundancy. So we have really improved our operating leverage. We've really improved it. And so we'll benefit from an uptick in revenue. So I'll try to finish on time.
Sure. Got a number of questions. You know, Harold, one of the things that you mentioned a few times is this idea that what you do is very bespoke for your customer base. And I guess my question is, why is that not a higher margin business in general? I mean, clearly you came into a business that was very low margin and you're working to improve upon that. But why is this bespoke business not just a naturally higher margin one?
That's a good question. We have a few big competitors. We have a few big competitors who do similar work to us. And I guess it's just a natural competition. The best part of our mix is actually defense. The US government's not great at procurement, so we get to charge a little bit extra for
Sure.
that. But for automotive production, they're good at procurement. So at the end of the day, they do dual source, so you have to be one of the best two. And there's a limited opportunity, I really think there, Brian.
How do you evaluate? So take that a step further. This is an automotive conference. We love having you, but
Yep.
are you best served being here? Are you best served being in the auto industry?
Well, our highest profit plants are automotive. So our number one most profitable plant is in China for making parts for the China market. Our second most profitable plant's in Kentwood, Michigan, to make parts for the US automotive market. So automotive is a good thing, when we think of automotive, and our brand name serving the automotive market is called AutoCam. So we have a strong brand name in the market, and we make really good money at it. The part of the company that we've been trying to rid and was losing money was commodity auto parts. And we were making them in Mexico and a couple other high cost plants, and it just didn't work.
Yeah. As you're thinking about M&A, which surprises me a little bit, just given your leverage, and that includes the preferred mezz debt. And so can you maybe explain to the audience basically your capitalization and what challenges you have?
Yep. We have $100 million of preferred stock. We have $100 million common stock. We have $135 million of net debt. So for us to do anything, it's going to involve debt and equity. So our preferred stockholder is Morgan Stanley, and their maturity, they're coming to the point of wanting to be refinanced out. And so our term loan is held by Marathon Capital. And so we have all of our stakeholders in constructive conversation to recapitalize the company.
What's ideal for you from a recapitalization standpoint?
Well, we definitely don't want to be levered in above the high threes. Yeah, we don't.
Yeah.
No, and among the various options on your previous slide, all the way on the right, you talked about the balance sheet and the focus on that.
Yeah.
But to accomplish your goals, what would you like to see the balance sheet look like? What are you sharing with the outside advisors as to what you need for 26, 7, 8 in terms of those goals? And the second part, there's got to be somebody that's interested in some of your businesses, including the sale of assets. So I don't know how much you can discuss, but I know all of that has to be work in progress.
Yep. So there's obviously a lot of options when you hit an inflection point like this, where the core business is finally attractive, and there's multiple angles that you can go on it. We have all options available to us, Mario. Yep. If we had a specific path, I wouldn't be able to say it with MNPI, but we haven't ruled out anything. No, we haven't. And we have the plan, to answer your first question, is we have a build-up plan to 1 billion. And if you've tracked my track record, I've done that twice, as has our Chief Operating Officer, Tim French, who I've worked with since 2003. And so we have a team that's done this. And so that's our base plan. And then there's so many deviations from that, but what do we need? We need capital partners who want to lend money on a path like that or invest.
And get a good slide there with business that's rolling off a low
Yep.
margin
Yep.
business that's coming on at the higher margin, and you mentioned $30 million, all else equal. So that's what, 8% on your 8% growth.
Yes.
You know, no matter what. As this matures for the next, 26, 27, 28, how much of that exit business can there possibly be relative to what you're targeting from a new business standpoint? And what are the differences in margins between what's going out the door and what's coming in?
Yep. So the portion of the company that's automotive is 40% of our revenue. On average, those programs last about 7 years. So they go into life and go into a refresh. So then there's another competition for who's going to win that. So there's an element of, and it back tests to be around 20 to 25 million a year. So there's a competition to win the next generation. It's competitively bid, and it's a different design usually. And our game plan is to gain above that. Usually towards the end of the life, it's not making much money,
Right,
due to price downs
that's
and
price down
meat
every
comps.
2.5%, 3% a year.
Yep, exactly. 3-3-3 is usually how you start out. And so you usually have a productivity plan lined up, 3-3-3, and negate it. So towards the end of life is when you really need to be, you have to have the leverage to say no. And in order to have that, you have to have an active pipeline and trying to win alternate business for those assets. The equipment we have in our plants is of two types. We do machining of rod stock. So we have CNC equipment like 9-axis lathes. And then we have stamping presses to stamp out metal parts out of coil. And then we weld or plate the items depending on what the assembly looks like. Yeah.
Medical is an interesting end market, although albeit small for you. Maybe talk about that and whether that's something that maybe just is too small and could generate a multiple
Yep.
from someone that wants to buy it.
Medical is one that we entered last year and talked about it. And we have an active pipeline there, and it is longer to get to prove to the customer that your quality system is sufficient to meet their requirements, but we are doing that. Defense has been a better alternate market for us.
Yep. It's just on defense.
Yeah.
Just, you mentioned the Patriot system. Where are
Yeah.
you on the Patriot system? Is it a consumable? Is it the actual?
The siding, the
Okay.
guiding. Yeah. So both of those markets are attractive for us. So we're equally attracted to both of them and have similar sized teams. And it's exactly the same machines that we already have. It's no CapEx required. So it fits what we do. Yeah.
In your journey, CapEx is 15 to 20 million dollars a year.
10 to 14.
Okay.
Yeah.
So as you're thinking about your ability before you engage in refinancing, you're thinking about maybe free cash flow before you get to your capitalization. Where are you and where do you need to be?
Well, we were really happy with the quarter we just had. It was a turnaround quarter for us. We generated $11.1 million of cash from operations. We paid for some CapEx, so we netted 9. So it was 9 million in the quarter, which this company hadn't done that.
Right.
Had not been able to do that before. So that was good operating cash flow. So I feel like
anything seasonal there.
no.
Okay.
No, it was just legit. And we were able to also get a lot from working capital. So instead of adjusted EBITDA, it was EBITDA. And we had the working capital coming down as we shed this business that makes no money. So free cash flow is what it is right now because, we're in the market now. So we're not waiting for another set of free cash flow activities. We're going to go with who we are. Yeah. We made up some time.
No, absolutely. I'm a little hung up on just the idea of M&A given your capitalization. So
Yeah.
How do you do deals at $100 million equity cap? Because you're not going to do it with equity.
No, you have to do it with equity.
Okay, so
Yeah.
basically at that point, you just,
You have to do it.
You're doing it,
You have,
okay.
yeah, it's equity-based program. Yeah,
Okay.
definitely is. And then it helps if the potential seller is willing to take equity.
well, that's the other part of it too, right?
Yeah. So
It's a partnership.
it definitely involves equity, but I can't really say, too much.
Sure.
But it's not a surprise to me that this day came, right? Because usually in turnarounds, it involves the balance sheet also. And usually my experience has been the operational turnaround doesn't cause the balance sheet turnaround. They're two separate beasts. But we have the company in position now to be pitching. And so that's where we are. Yeah. And I'm very thankful to be here and speaking about it again. Appreciate it, Brian. Mario.
Wasn't an issue that you created, but it seems like you have a good plan to solve it.
Yeah, for whatever reason, I like to do these kind of jobs.
Go ahead, Harry.
Yeah, Harold, thanks for a lot of great Q&A. I guess as you think about the refinancing, how married to your assets in China are you, both the wholly owned plant and the JV?
Yeah, it's a good question. So we have a 49% JV. If you look at our P&L for this year or last year, it's around $9 million is what shows up in other income. And that 49% JV share can be sold. And Deutsche Bank just did one in the town that we're in, Wuxi, last week. A 38% share was sold at a good multiple in the market. And that's something that we're looking at too. Yep. In fact, I'm going to China the week after Thanksgiving and meeting with our other shareholder there to talk about that. I don't need their approval, but we're transparent with each other. So it's an option for us this year.
Yeah. Well, interesting ideas come in all sizes, right? So this is one that's certainly a challenge that you took on. And it's good to see that you're moving in the direction that you wanted to. So Harold, I thank you very much for being here.
Thank you.
I thank my colleagues for being a great and attentive audience for the day. That concludes our program, and we'll see everybody who is attending the dinner at 6 o'clock for cocktails at the Left Bank Room in Paris.
Thank you.
Thank you.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921-5118 info@gabelli.com.